Richard has a story that he always tells us about going to the corner store as a kid and what his money would buy them. And it seems like such an amazing event. So I'll just let him tell it.
Well, it was magical. All these memories you have as a kid. My grandparents had an upholstery shop, and after my grandfather passed away, my grandmother kind of she did the sewing department. She was down there sewing cushions and pillows and stuff for upholstering jobs, and we'd go and visit on Saturday mornings, and the first thing that she'd do is she had a bag of donuts from the bakery, so we got to have some of that. But then she'd send us on our merry way, and she'd give us 25 cents each. Around 1970, 70 to 73, it started going up towards 50 cents eventually. We'd take those one or two quarters, and we'd head down to the corner store. It was literally a block away, and it would get us maybe a chocolate bar, some candy, a pop, and a comic book. And sometimes we'd put a dime into the machine where you get those cool little prizes, and we'd do that. But we did all that for like 25, 50 cents.
Mhm.
And today you can't do one of those things you'd be stretching $1 if you could just get one of those things for $1. That's inflation.
Yeah.
Stuff gets more expensive. Nothing's ever changed, right?
And I think the one thing to highlight off that story is inflation is inevitable. It's also something that creeps up on us, but
Absolutely.
it is actually an important component of economic growth. But
Yeah,
as you were mentioning, it does take away our purchasing power. And
completely.
yeah, as the prices of goods and services increase over time, it's a simple fact that your dollar will buy less.
Yeah,
And
yeah.
yeah.
You know, let's use another example. And this goes back over a century, the 1916. 9 cents would buy you a quart of milk. Oh, we didn't have metric then. It was a quart. Okay. So let's just say a liter of milk. 50 years later, that 9 cents would only buy a small glass of milk. And now, another 50 years, 100 years later from 1916 or so, 9 cents is going to buy you about 7 tablespoons of milk,
Mhm.
right? Stuff gets more expensive. Okay.
Yeah. Now, there are risks to investing, right?
Mm-hmm.
There's a bit of a transition, but there are also risks to not investing. And
Oh, yeah.
inflation eroding your purchasing power is one. And again, as I mentioned earlier, it just creeps up on you. Slowly but surely, your
Yeah. Yeah.
dollar buys less.
Yeah. Yeah. And,
So how do
go ahead. Go ahead.
Richard, how does this relate to your financial plan?
It's especially important for people that may have a fixed income. Now, there's not too many pension plan holders left where there's not an indexed pension. Typically, defined benefit pension plan members have an indexed pension, so that there's nothing too much to worry about, although that indexing to inflation isn't necessarily guaranteed. But some people actually have pensions where they don't go up inflation. So they might have started and retired 20 years ago and they're like in their 80s now, and they're still getting $1,000 per month, which seemed to buy a fair amount 20 years ago, but today it just doesn't buy as much. And the same thing goes for people who are on like a fixed annuity. They put their money into an annuity, and that annuity pays them a fixed sum, and over time that income gets encroached on by inflation. Or
Mhm.
people that might have locked into a term deposit rate at 1 or 2%, and they're not, we call that, they're falling even behind inflation now, way behind inflation. We call that, that's the risk. We call that going broke safely, don't we?
Mhm.
Right?
Now you
It's
mentioned one you
yeah.
mentioned one phrase there that I think anyone could use a little bit more explanation on. You mentioned indexing.
Yes.
What is indexing, and how would you explain it to somebody who does not know much about uh, personal finance?
Well, what indexing does is let's just start off with maybe $1,000 per month pension. And let's just assume it's indexed to inflation. It goes up with inflation, and typically they follow the consumer price index in Canada, which is the measure, not a perfect one, but the measure for inflation. And let's just say inflation goes up 4%, which it kind of did last year. Okay. So all of a sudden, then the next year, that $1,000 indexed pension, and Canada Pension Plan is an indexed pension, and so is Old Age Security, an indexed pension. That $1,000 per month should be $1,040. That's a 4% increase to correspond with 4% inflation. And if you've got that going, you've got a good thing. But very often, the inflation that you're experiencing is actually higher than the consumer price index in many other different, for instance, in real estate, in fuel, and various types of groceries that have been hit by these supply chain problems that we've had. Our inflation has actually been much higher depending on the basket of goods that we're purchasing, right?
Mhm. Now, I think for anyone to understand inflation, they first need to understand supply and demand curves. So we're
Mm.
going back to basic economics.
We're going
So
back to economics.
basically supply and demand curves is the supply side, they want to sell as many goods for as expensive as possible. And the demand side, they want to buy as many goods as at little price as possible. When these two curves intersect, at some place, it's called the market equilibrium. And that is generally the price at which people transact at.
Right.
So when anyone or anything impacts the supply, whether making it more expensive or making demand drop or demand go up, or supply go down, these all have impacts on inflation, whether it increases inflation or decreases inflation. The one that
Certainly.
we're seeing now with supply chain issues is it's increasing not only the cost to supply, but it's also increasing the demand.
Yes.
So this is
Yeah.
where we're seeing big prices shift.
And we got kind of comfortable with low inflation over the past decade or two, and honestly, I think that's about to change. I saw a recent report, actually, I think just this morning, on all the different factors that are telling us the future is gonna could look substantially different. I'll give you an example. There's a lot of baby boomers who are finally deciding to retire. Okay. Many of them were holding on for quite a while, especially given that many of them are healthy. They still want to keep working, but they're finally deciding, okay, I'm going to stop working for a living and just pursue my passions. And the ones that are taking their place now, the younger generations are saying, you might have been happy with that income that you were receiving just prior to retirement, but I've got I've got a deeper set of tools. I've got some more experience in newer approaches to things, and I think that my skill set demands a higher income, and they're asking for it,
Hmm.
right? So they're coming into a workplace where we're having this great resignation, we call it. People are leaving, and it's hard for employers to retain people, and the next generation is demanding and getting higher wages. Well, guess what? Higher wages equals higher inflation because employers have to pay more in wages. They're going to have to increase their goods and services that they manufacture or provide, and all of their input costs go up. They're going to have to
Hmm.
increase prices, which will give us increased inflation as well. You mentioned the supply chain issues. There are, of course, fluctuations in demand for raw materials. Raw materials are getting more expensive to extract from the earth, for instance. Those prices are going up. We've seen droughts that have happened across North America, and that is leading to scarcity of food. So the supply is lower on different types of produce and fruit, etc. Um, for instance, even up in the Fraser Valley, we had a massive death of a lot of cattle and livestock. That's going to lead to supply chain issues, which means
Hmm.
prices are going to go up. Lot of contributing factors to a potential for inflation to be higher than we've experienced.
So basically, the premise we're trying to say here is inflation is very real and it needs to be factored into your financial plan,
Yeah,
especially as it relates to your real rate of return and
for
future
sure.
spending.
Yeah.
Um, it is an important consideration when investing. And a primary reason behind that is because we're saving today in order to support our future lifestyle. And a big goal for many investors is to actually keep pace and ideally outpace inflation.
Yes. Yeah.
Yeah.
That's the big goal. And if we take it back to, for instance, the comparison between an individual like you and I and our families going out into the market, what we want is we want the utility of the goods and services that we acquire. We recognize that the prices of those goods are going to go up over time. And so we have to match that with the type of assets that will accommodate that kind of inflation. What I'm talking about here is I'll give you an example buying a piece of real estate, for instance, that will go up in value to match inflation and also provide rental income that we can use. That's the real estate comparison. But in the stock comparison, for instance, we want to buy shares of companies that are producing a valuable good or service and are going to give us a rate of return. Now, that's going to be expressed either as a dividend that we get, or it's going to be expressed as a growth in the value of those shares over time over and above inflation. We're going to need to match the investments that we invest in with the challenges that we face out in the marketplace. And stocks and equities, including real estate, they tend to do that over time, even though they fluctuate. But there's one asset that doesn't quite do it, and that's the bond, right? That's ownership versus loanership. That
Well,
bond is,
there's the bond, but there's also cash, which is the
uh,
worst of the versions.
well, yeah, we need to begin with that. Take, $100,000 and stuff it underneath your mattress in case somebody, or just put it into a safe or something. It's not going to do anything for you.
Yeah.
You can draw on it. It's not going to give you a rate of return. It's not going to keep pace with inflation. That's the worst asset to own,
Yeah.
right?
So I think it doesn't take much to see news about the inflation in this time right now. But I think underlying this focus on inflation, this hypersensitivity towards inflation, this attention seeking from inflation, um, people are wondering a few things.
Yeah.
Number one, am I worried about inflation eroding my standard of living?
Hmm.
And how can investors potentially prevent this loss of purchasing power from inflation over time? And here's the biggest one: am I going to be okay?
That's the big one, right? And are we looking for a solution then?
Before we jump to solutions, how do you
Hmm.
think these questions are making people feel?
Um, Anxious.
Yeah.
Um, Security seeking. They, here's the funny thing: is the very thing that you seek to remedy the problem could be the undoing of the solution. So by looking at short-term secure assets, i.e., I'm worried about inflation, but I'm also worried about fluctuation in the stock markets, et cetera. We're going to undo ourselves. You know, one one asset class that in inflationary times does horribly And I saw this in the late 1970s. All I saw was Time magazine covers that were, like stagflation and inflation and all these crises of the day happening. But the big emphasis was on the fact that we had double digit inflation. Goods and services and wages were going up by more than 10% per year. And that was a serious, serious problem because our purchasing power just wasn't catching up. So we tried to pursue risk averse assets in a time when we should be pursuing growth assets. And during that time, the bond market, as interest rates rose to combat inflation, the bond market, which is, think about this, the bond is one of the most secure assets out there. Government bonds are secured by the full faith and credit and the government's ability to tax and print money. Um, they just lost massive value because people were holding 5% bonds and interest rates were going up to like 20%, and nobody wants to buy your 5% bond until maybe you give me like a 30, 40, 50% discount on that bond. People were buying the wrong assets at that time and ignoring the fact that the long term, buying free enterprise, buying shares in companies that are producing goods and services profitably for their shareholders, that was actually the way to go during that time. Another approach is, people will head for the hills and just say, okay, time to buy gold,
Double
right?
gold. Time to buy
Oh, yeah,
double gold.
leverage the gold. Well, it sounds cool. Gold, in its essence, is an element, and it is it doesn't corrode. It retains its purity. It is transportable across borders. It people like the idea of holding a few bricks of gold. But Matt, we need to go back a few thousand years here during the times of the Roman Empire. And historical records have shown us that, of course, Roman soldiers were actually paid. They weren't slaves or anything. They were paid good dollars. Like not guns for hire. They were spears for hire, right? And the amount of gold that they were paid, in coins, was equivalent in value, like a couple of ounces of gold that they would receive is kind of equivalent in value to the wages of a soldier today. Nothing much has changed.
Hmm.
Another saying that has been bandied about is that an ounce of gold has always bought a men's suit. Now, sometimes that's a Moore's classic, and sometimes that's a Harry Rosen or some other kind of a
Sometimes
label.
it's a bespoke.
Sometimes a bespoke, mind you, I just found a tailor that can do a bespoke suit for $800.
Oh
So
wow. Well,
that's
that's off
something.
the record.
That's something to look at. Okay, but gold has done nothing but at best keep pace with inflation. It doesn't give us a dividend. It
Hmm.
doesn't give us interest. So it gets part of the equation maybe correct, and that is keeping pace with inflation. But it does nothing for yield. It gives us no yield over time.
Yep. So I think getting back to the point of inflation needs to be planned for, you always have a quote that you like to say when you don't have all the information, you tend to what?
I tend to hallucinate.
Yeah.
It's true. If there's an information vacuum,
Yeah.
I will hallucinate. Think about it. Your body, if you're in a state of oxygen deprivation, you will hallucinate. In the
Yeah.
absence of information, you will hallucinate also, right?
And my point here is the future is already uncertain enough.
Yep.
We don't need to add another worry about inflation to it.
Hmm.
So, the plan, what do we do about inflation?
The first thing that we have to do is we have to realize it and recognize it as a serious problem and not just avoid it. Okay, we have to plan for the fact that the income that you desire today in spendable dollars, if, for instance, you desire financial freedom, if you were to stop working for money today and need an income and you need $6,000 per month in order to pay your bills. Well, with inflation over time, in the future, you actually might not need 6,000. You'll actually need 10,000. The amount that you're going to need to buy the goods and services that you buy today is going to be different in the future. We just have to recognize that. And then we need to build that into a plan. So you can do that successfully with good planning software, um, but you also then, in addition to that plan of recognizing inflation, you have to build in the kind of rate of return that you might be assuming. That you have to build in the kind of risk that you want to undertake, and then from there you need to work it backwards and build a portfolio that takes into account your unique risk um, profile, and also recognizes the amount of time that you're going to need that money for, and work it backwards. It all comes down to the financial plan. And part of that financial plan then is building a portfolio that is going to take you there. And you, you could turn this into a full-time job and try to do it yourself, but we've seen all kinds of DIY projects kind of fall on their face. I would really you know, encourage people to find a trusted advisor that they can work with who can help them understand, number one, their values, what they really, really value in this world. And number two, set up the goals that they want to achieve, be it financial independence and having spendable cash of X amount per month and being able to leave a strong legacy for the next generation. And building a plan to fulfill that.
Now, we talked a lot about asset classes that kept
Yeah.
up with inflation and outpaced inflation.
Yes.
Let's jump back into that a little because we have a lot of data on this. Now, I will say this up front, there's not a perfect correlation. There have been times where the S&P has returned negative returns, negative real rate of return.
Yes.
But
Yep.
in the long run, we're talking about in the long run, we need to have a properly structured investment plan in order, as you were saying, to fulfill our goals and to achieve that financial freedom that we want.
For sure. After taxes and inflation, um, uh, government bonds will tend to leave you high and dry. They might give you the income that you might need, but they will fall behind inflation because let's take $10,000 in a government bond at 2% over 20 years, say. So let's say a 20-year bond.
Mhm.
It might be yielding today maybe 2% and maybe 2.5%. And you buy that, and that's going to produce for you $250 per year. And when that 20 years is up, you'll still be having gotten $250 a year. It has not gone up. And that $10,000 that you put in, sure, you get it back when that bond matures, but that $10,000 after the end of that 20 years is probably only worth 3 or 4,000 purchasing power.
Mhm.
So
Now we
bonds
call
are,
that what?
well, again, as going broke safely.
Yeah.
That's a horrible experience. See, fixed income investments warn us by their very name. Let's break it down. It's income that is fixed. It's
Yeah.
not going up. Okay, it warns us. So that's one asset class that is good to have in your portfolio should there be a sustained downturn in your stock portfolio, and you might need to have enough liquidity through bonds, etc., to
Yeah.
last you maybe 10 years, because it's usually very rare that stock markets lose money over 10-year periods, and certainly over the past century, investing your portfolio in a diversified portfolio of stocks has never lost money over rolling 15-year periods. That's
Mhm.
something to keep in mind. Okay.
And we talk a lot about fixed income, and we kind of we're not kind of nice to it. We downplay it, but we have to admit it is important. And the one
Yes.
thing I really want to point out is in the context of your plan and goals, you it's good to have fixed income.
For sure.
in the context of your plan and goals.
Exactly. And it depends what I mentioned one of those. You need to have a portion in your plan to sustain a downturn in the stock markets. And that's why it might be 40% in bonds. It all depends on your situation. Every major pension plan out there, the Canada Pension Plan, the BC Pension Plan that's there for, teachers and municipal workers and firefighters, etc., that is there. And underneath that pension plan, they have about 30%, 25 to 30% in bonds in order to meet payment obligation to pensioners during downturns in the stock market, because they do happen periodically, right?
Mhm. Now, I did mention one period of time. Um, it was between 1966 and 1982.
Yes.
The S&P 500 returned 6.8% before inflation,
Okay.
but after adjusting for inflation, it was zero.
Yes.
Its real rate of return was zero.
That's right.
Additionally, from 2000 to 2009, and you referred to this as the lost decade, or everyone refers to this as a lost decade, the real rate of return of the S&P dropped from negative zero point 0.9 to negative 3.4 after inflation. These periods are not correlated with each other, and they don't match up nicely.
Yeah. Yeah. It'd be interesting to see, what was that period again between 68 and 82?
Yeah,
Okay. It'd be interesting to see the rate of return for bonds during that time, because it could very well have been negative, wasn't it?
I would have to get the data on that.
We have to take a look, because interest rates spiked like crazy towards 1982, really decimating bond portfolios. But it'd be interesting to dive into that. Well, but that's neither here nor there. The truth is, there are going to be these long-term periods that we experience that may discourage us. And like one thing I've always said to clients is that, look, stocks go up on average 2.5 years and they take a year holiday. So I call that 2.5 steps forward, one step back. 2.5 step forward, one step, 2.5 forward, one step back. Guess what? We're still making progress. But remember still that 2.5 steps forward in terms of years and a one step back, that can also happen to longer time cycles. So you mentioned two of those, the period from 60 68. I like to take a look at the period between 64 and 74, right? That was kind of flat, like nothing happened during that decade. You mentioned another period, the 2000s, 2000 up until 2009, 2010, just flat. All kinds of crises happening during that time. Stocks never really returned a positive return at all. And then there was that period between 1929 and 19, 1930 to 1940. Okay. That was a lost decade. Okay. But they were separated by 2.5 decade periods of strongly positive returns in the markets. So again, we have to recognize those long time cycles and allocate our portfolios accordingly, so we have a safety blanket that tides us through another potential lost decade,
Mm-hmm.
and yet still position our portfolio, if we believe in free enterprise, position our portfolio to capture the returns that invariably happen after such lost decades.
Yeah,
See what I'm talking about?
yeah. So basically, an important thing here is the worst thing we can do in the face of the bad news of inflation is react.
For sure. Yeah.
Hmm.
And right now we're fearful,
Yeah.
because we not only has inflation jumped from 2% to all of a sudden 4.5% for the calendar year 2021, but now, right now, because of these supply chain issues and global events, et cetera, it's looking like 8-9%. Is this temporary? Is this permanent? We don't know, but we need to position portfolios to be able to be ready for it.
Hmm.
Okay. It all comes down to intelligent portfolio design. And guess what? The masters of this in the long run have been the pension plans. Okay, never mind the day trading numbskull on social media that's telling you what to buy and sell and what crypto is the hottest thing lately and nonsense like that. Look towards the serious managers of serious money in institutional plans, people like Warren Buffett, who've got just decades and decades of intelligence and experience. We need to look to them in terms of how to design a proper long-term portfolio for our needs.
What was that quote that timing the market never works, but time in the market always works?
For sure, and I love the Buffett quote as well. What's important in a successful investment experience is not speculation. It's not masterful guessing and stuff like that. It's the ability to have a sound intellectual framework and not let your emotions corrode that framework.
Yeah. So I think another thing that people can do if they're actually really worried about inflation is take an inventory of all their future sources of income, which will be indexed and which will be inflation protected. So what we're
Yep.
talking about here is an indexed pension, their CPP, their OAS, potential workplace salary increases. So those all also need to be taken into account. Again,
You
when
know,
we don't know the information, we will hallucinate and we will turn to the worst possible situations.
For sure. Matt, I love the virtual planning sessions that we have with a lot of our clients where we do it through this window, through this digital window with our cameras and screen sharing. And we go through the plan and something's not making sense. Like we look underfunded in retirement. And, sometimes we take a look at the settings and realize, whoops, we forgot to, we didn't set your pension to be indexed, which it is. And all of a sudden, that makes a world of difference.
Yeah.
Or, whoops, we exposed too much of your portfolio there to low yielding bonds rather than a diversified portfolio that gives you a greater long term return. And just little tweaks like that in the long haul can make all the difference in the world to being able to create an income for the rest of your life that continues to keep pace with inflation and still preserves the purchasing power of your investment portfolio.
Hmm. Now, if people are still worried about inflation and they're looking for help, what I would encourage them to do is honestly, if you want, book a quick call with us.
Yeah, quick chat. We love having those.
Now, with this all said and done, what does it look like when we account for inflation in our plan and we stick to our plan?
Two words come to mind for me, Matt, is financial freedom and confidence. And I think the confidence comes before that freedom. We got to build that confidence. Um, Dan Sullivan, founder of Strategic Coach, had a really useful framework that he called the 4 C's of confidence. And that is, first of all, we have to have some courage. We have to have some commitment, first of all. We have to commit to in my mind, in our minds, we have to commit to putting together a serious financial plan. Then we have to have the courage to go through the work that it takes to build that. And we do that side by side with a trusted advisor. That's the best way to do it. And as we go and do the works, not all at once, but step at a time, guess what? We develop all these incredible capabilities towards financial freedom. And all of a sudden, if I'm armed with all these capabilities after having done the work, guess what? I'm confident. I've got financial freedom and I'm feeling really, really good. That's the feeling that we should have going forward in being able to meet those goals that really, really matter to us.
Hmm. Well, with that, I think we will end this discussion on inflation.
It's been a great
Again,
talk.
it's been a great talk. We will put links to our in we will put links to our calculator to see the impacts of inflation. But if you're really worried about the impact of inflation on your financial plan, again, I would encourage you to book a quick chat with us.
We'd love to have a talk. Thank you so much, Matt.